All right. How is it going, everybody? Welcome to Decentralized Masters' first ever podcast live with you. My name is Preston Eckhardt. I am one of the mentors here at DM. And yeah, it's really great to have you guys here. I'm really excited for this episode. Obviously, it's our first ever, podcast. And my goal today is to try and kind of give you guys a little bit of the lay of the land, if you will, for Bitcoin, crypto, macro. How do we make the most of the upcoming bull run, right? We all know that crypto tends to generally follow, a very particular cycle. Markets are booms, busts, everything in between, right? It's very clear that we have a big boom on the horizon. Obviously, as many of you guys know, we've had a lot of investor interest, institutional investor interest, smart money, as they say, coming into crypto in the form of Bitcoin ETF. So ETF products, exchange traded funds, for those of you that don't know, Ethereum ETFs, right? And I'm sure there are probably numerous other TradFi, traditional finance, legacy market based products on the horizon, right? So this is a pretty exciting, very pivotal moment in the history of crypto. I've been in crypto for about 6 years. I kind of first got started way back when I was still in high school, like in 2013 or somewhere around there. I was mining Bitcoin for fun, right? That was kind of how I got exposure to, crypto, Bitcoin initially. And I was, bit by the bug. And ever since then, I've had, an ongoing interest, in crypto and finance. In 2015, I eventually joined the military, the U.S. Army, was doing intelligence and other, special missions units things while I was in. And while I was actually in Korea in around 2018, I started doing, some crypto-based investigative analysis into North Korea and some other things. And that was kind of where I rekindled my interest and love for crypto. And it was pretty interesting, watching a whole other nations, other countries use crypto to do to meet some particular end state, right? And seeing how it was able to also change the lives of people that did not have access to traditional finance, to lending and borrowing, liquidity provisioning, finding a way to actually generate income, right? Crypto, and I guess more broadly DeFi, enabled that for all kinds of people all over the world, and it's a really powerful thing. And being able to see that while I was in the Army and being able to help be a key advisor to various command and staff, generals, high-ranking officers across the U.S. Army, was really cool and impactful. And that's why, here I am today, years later, still trying to add value, still trying to help teach people about crypto, DeFi, and do my part for the ecosystem. So with that being said, I'm going to go ahead and share my screen here, and we're going to do a little discussion about Bitcoin macro. So as you guys can see here, I'll go ahead and turn off some of the spaghetti indicators we've got here to make it a little bit more clear what we're looking at. Here we have Bitcoin, everyone's favorite digital asset, the one people most know about, right? So as you can see, we've pretty much been ranging for a long time over, the last, 6-7 months or so, right? We've been traversing this range for a very long time. And, over the last, I want to say, couple of weeks or so, we finally entered a period of time where Bitcoin and the broader crypto market is finally ready to explode to the upside, right? Or at least that's what it seems to be doing, right? So here, around this area over here, in late October, just in time for favorable October seasonality to kind of kick in, we started seeing some favorable movement to the upside. And now Bitcoin is sitting at, roughly 70K, 71K, right? Kind of peaking out a couple of days ago at 73.5, just shy of our previous all-time high. So this is pretty incredible, right? We've finally broken out. Bitcoin is ready to start pushing all-time highs. We've got a lot of liquidity starting to finally build up, and hopefully enough to finally rocket us up to beyond all-time highs. If we do break above, previous all-time highs at 73.8K, I fully assess that, open the floodgates at that point, release the Kraken, as they say. No pun intended for the Kraken centralized exchange. Sorry, dad joke. But in any case, I can definitely see us hitting 80K if and when we finally break above this previous all-time high right here. That would definitely push us up higher. And at that point, retail and other sidelined investors, sidelined capital, dollar bills, etc., will be looking to finally get into, crypto again, to step back into Bitcoin and other assets, right? So we are in a bit of a pivotal moment, a very critical period in Bitcoin right now, right? All eyes at the moment seem to be on the labor market data that is due to come out tomorrow. We're seeing a slight de-risking in the market today, leading up to what should be a very big macroeconomic data point tomorrow. So I fully expect the numbers to probably be pretty favorable. Obviously, no one knows for certain, but assuming all goes well with US labor market data tomorrow, I imagine that will be the rocket fuel we need to finally break higher and push towards our 80K level. So pretty exciting stuff. Now, with that in mind, right, we all know that crypto, if not today or tomorrow, right, Bitcoin, if not today or tomorrow, right, at some point very soon here, will eventually start pushing all-time highs, right? It will eventually start breaking out, and then at some point start to level off a little bit, right? So what can we do as investors? For those of you guys that have been here with us, have been learning with us, attending our office hour sessions, learning from the mentors here at DM, learning from all the research and the resources that we provide to you guys, you already have an idea of what to expect, right? You should hopefully have already positioned a large majority of your spot portfolio within crypto across a variety of different, blue chip assets from Bitcoin, ETH, Sol, etc., into some mid-risk trades, some mid-risk altcoins, and maybe a little bit of high risk, right? Some of you guys are holding some meme coins, other small caps, right? And if you guys are positioned, then you're pretty much just ready to take off at this point, right? But for those of you that aren't, right? For those of you that are still kind of just like getting into things, you're just kind of exploring, crypto. Maybe you hold some Bitcoin, maybe you hold some ETH, but you're not really sure what to do. You're not really sure what to expect, right? Well, if and when we finally have this, moonshot to 80K, right? At some point, other assets within crypto are going to finally start to follow, right? It'll be Bitcoin at first, but generally speaking, we tend to see a small mini cycle within the broader cycle, right? So initially, Bitcoin leads the charge, right? Bitcoin shoots up. It starts to drum up a lot of interest. It sucks up liquidity and additional capital, pushing it further. And then eventually, as people start to make a lot of gains on their Bitcoin, money starts to trickle out of Bitcoin ever so slightly and into alts. Namely, historically, it's always been ETH or Ethereum, right? This cycle, I think it's safe to assume we should also see some money flow into Solana, quite a bit actually. So these would be the next two tokens to be looking out for, right? So this is easily or more easier represented using the ETH BTC chart or the ETH Bitcoin chart here. As you can see, it's had a bit of, some underperformance. This is pretty stock standard for Ethereum or ETH BTC. It looks like it's starting to find a bottom soon. And if and when it does, right, maybe a little bit more down. But once it does find that bottom, it starts to shoot up. And when it does shoot up, it shoots up pretty quick, right? And you can actually see this represented here in the previous, cycles or previous iterations of this, bull cycle. When ETH BTC bottoms out, it starts to shoot up pretty quickly, right? And when this happens, historically, your favorite altcoins tend to follow, right? We are now looking at total 3, crypto total market cap, excluding Bitcoin and ETH. This is a great gauge of the broader crypto asset class, not including the, obviously big 2, the big blue chips, Bitcoin and ETH. And as you can see, it's starting to form a bit of a higher high, lower low, very bullish. And again, very similar to ETH BTC, I fully assess we should start to see some rocket fuel to the upside very soon, right? May not be a full-blown alt cycle, but it will be, soon. So for those of you guys that are holding your alts, this is a chart to look out for. Once Bitcoin finally starts to take off and once it starts to kind of plateau, probably around the 79, 80K mark, this will be something to keep a very close watch on. For those of you that are really over allocated or heavily allocated into altcoins, mid caps, small caps, memes, et cetera, right? So going back to our cycle, right? ETH, SOL, those two coins start to really take off, right? And when those do, all the ecosystem coins, also known as alts, within Ethereum, within Solana, they start to get a lot more additional liquidity, right? Additional capital. We start to see more DeFi activity, TVL increases, volume increases. A lot of money starts to flow into these alts. And of course, when it does, you'll start to see this bounce pretty sharply to the upside, right? And then your alt starts to outperform Bitcoin, ETH, SOL, etc., right? And then eventually capital finds its way into the ultra risky end of the spectrum, which historically have been memes and other small caps, right? Small caps. And these coins right here are usually between alts, meme coins, and small caps. That's usually when you start to see, your 50x, 100x opportunities that everyone loves to find in crypto, right? So once these go parabolic, once small, meme caps and small coins start to go parabolic, eventually money finds its way back to safety, right? And then you get the next iteration of, Bitcoin rallying to the upside, pushing to our potentially 100K mark, which is really what everyone's looking forward to, right? Everyone's trying to see 100K Bitcoin. Very exciting times. So yeah, that's kind of where we're at right now as far as Bitcoin macro goes. The big elephant in the room, of course, is elections, right? We've got elections November 5th coming up. Does Bitcoin go down? Does it go up? Does it stay stagnant? What ends up happening, right? Now, of course, no one has a crystal ball, but historically, election years for crypto have proven to be very bullish, right? Post-election rally is a absolutely real thing. And as you can see, markets, not just Bitcoin, but even legacy, right? We've got the S&P, SPX, right? Already pricing in what could be a Trump rally, a Trump victory, right? Which is, a lot of people seem to believe that a Trump victory will be very bullish for crypto assets, for risk assets, for the dollar, etc. And that's why we're starting to see a repricing, an aggressive repricing to the upside for various assets, right? Now, if Trump is not elected, I'm sure we could see some, temporary, instability, market instability, maybe some selling off to the downside. But shortly thereafter, I fully imagine whatever happens, regardless of the election outcome, all markets will eventually start to rally anyway. Would it be potentially a much stronger rally with Trump elected? Potentially, right? But hard to say ultimately, right? And if you just zoom out, right, this is where we're at now, and we're starting to really break out to the upside, right? So no matter what, we're definitely on track to do, a six-figure Bitcoin leading into 2025, our big bull market in 2025, right? So for those of you wondering, what should we be doing now that Bitcoin and ETH have started to surge, right? Well, hopefully your bags are packed. But if they're not, the best thing to do is to look out for small retraces in the market. And hopefully you can start to deploy your DCA plan or your dollar cost average plan, right? Since ultimately, nobody knows what ends up happening, and when it's going to happen, these rallies, the best thing you can do is to dollar cost average into your favorite assets, your high conviction holds, and do your best to capture as much upside as possible while limiting your downside exposure, right? So for Bitcoin, we're seeing a bit of a down day, right? Today could be a decent day to buy in, right? Same thing with Solana, bit of a down day, right? Tracking Bitcoin, very correlated. Could be a good time to buy a small bag in, Solana as well. ETH, same story, right? And you can continue to go further out on the risk curve to altcoins such as SWI, Dogecoin, etc. The goal is to kind of find the coins that have been performing really well relative to Bitcoin, right? Those are the coins you want to pay most attention to, right? What coins have shown strength in the face of adversity, defying Bitcoin's price action. Here's SWI, for instance. This is one coin that we have talked about here at Decentralized Masters for a very long time. Way back before this got as much institutional interest as it has. And as you can see on the SWI Bitcoin chart, a lot of strength in SWI, right? Starts to bounce off some of these key support levels. Very solid bounce off the golden pocket, undoubtedly. If we were to do a little fib here, right? Very strong bounce here in the golden zone, as we say. Looking to push all-time highs, right? We could be seeing a $3 per SWI token very, very soon. Same thing with Doge. Very, very strong, right? You can't underestimate the Elon pump, right? We can't fade the Elon pump. And as you can see, we're starting to get a very strong bounce here, very strong rally. And again, very possible that Doge starts to push towards previous all-time highs, right? In the 2020, 2021 bull market, right? So if you zoom out, we're way down here, right? And this is where generally people are trying to target, right? We tend to eventually during bull markets outperform the previous all-time high. So that's what things are going to trend upwards towards. So those are a few that I'm looking at specifically, right? Another interesting indicator is the Bitcoin historical volatility index. As you can see, once Bitcoin historical volatility on the 2 weekly starts to push into this red zone, about 90% of the time, very accurate indicator, very accurate signal that Bitcoin is going to start pushing to the upside very, very heavily. And we are now getting, quite a few wicks back into this red zone, right? So it remains yet to be seen where we go with this. But again, just another indicator for us to look at and analyze and see where we go from here. So that being said, right, we understand that Bitcoin is on its way up. We know that ETH, Sol, and all the other blue chips are on their way up. And we understand that usually once Bitcoin breaks its all-time high, we start to see money, we start to see liquidity flow into our altcoins, right? And a lot of this will most likely happen post-election. So as we head into November, as we head into the final innings of Q4, where everything starts to rocket, the best way to kind of capitalize on this, in addition to holding your assets, right, and dollar cost averaging into your high conviction holds, will be to also generate yield on some of these assets that, have the ability to generate yield on, right? That's what we're here for. We are DeFi investors. We are, DeFi enjoyers. We want to find ways to double dip, if you will, right? How can we make the most of holding our Solana? How do we make the most of holding our Ethereum, our altcoins, anything in between, right? Well, fortunately for us in today's day and age, there are many yield-bearing vehicles that we can take advantage of to ultimately have our cake and eat it too, right? So in addition to some of the, basics of just holding our assets, right? We have other DeFi, decentralized finance based ways of generating yield, right? So this is a decentralized, application known as Kamino. This is on the Solana blockchain. So one thing you can do, right, is you can provision liquidity. Provisioning liquidity is a great way of generating fees, as we say, also potentially rewards, farming fees, whatever, however you want to, put it. And you can basically extract yield on top of holding the underlying Solana asset, right? So as you can see, there are quite a few vaults here on Kamino where you can basically connect your Solana-based wallet, liquidity provision these two assets, and generate some yield on top of it, right? And as you can see, you can get pretty degen, as we say, with some of these yields, above 99% for some of them. Of course, we don't want to be chasing just high yield, right? Generally speaking, we would like to establish a margin of safety, right? We already know that there is some positive expected value across all of these vaults, all these LPs, but we also want to make sure that we have a margin of safety, right? We don't want to be going all in on double volatile pairs, meme coins, etc. So what do we look for? What exactly are we trying to do here, right? So if you hold Solana, and you are trying to find ways to generate some additional yield on top of it, right? What you might want to look for to keep it nice and safe is like asset pairs that are both Sol based or Solana based, right? So if it were me, right, and I'm looking at the Sol chart and I imagine, hey, it looks like we're about to finally get this final leg, this final push up to all-time highs, right? Break above the $200 mark. How do I generate additional yield on top of capital gains appreciation, right? Well, by deploying some of your Solana, doesn't have to be all of it, right? But by deploying, a decent amount of your Solana portfolio into some of these vaults, these like asset pairs, you get the added benefit of essentially getting all the vertical price appreciation of the underlying asset that is Solana, whilst also generating some stable yield, right? So as you can see for this Jito Sol vault, for instance, you can make a solid 7.9, so almost 8% on top of your capital gains appreciation. You also have M Sol, which these are just liquid staking derivatives of Solana. You can make another 7% here. Jito Sol, 6.4%, right? And you can kind of go down the list, right? Here is another JTO token / Jito Sol, which is paying 40%, right? Much of which is probably rewards APR plus some fees generated, right? And again, you can pretty much go down this list. And what's nice about these vaults is that unlike a traditional or manual LP, you are actually able to allocate capital and you don't have to worry about essentially managing the LP yourself, right? Which is a big issue. Historically or traditionally, back in the day, right, with DeFi, when it first came to light, these LPs had to be managed manually. And this is why like asset pairs were so strong, was that with a volatile pair, say Solana USDC, if you were doing it manually, what ends up happening is that as the price of Solana starts to go out of your bin range, to the up or downside, you start to incur impermanent loss. So although you're generating quite a bit of capital, quite a bit of money return in fees generated, you usually have to make sure that you're generating enough fees to offset the impermanent loss that you may experience, right? To the up or downside. The downside impermanent loss usually being the worst or most egregious capital destruction. So with these vaults, however, you don't have to worry about impermanent loss as much, right? Essentially, these vaults, you basically put your money into the vault, and then the vault manages that liquidity on your behalf. So you pay a very small, like 10% maybe performance fee. It'll let you know how much. And then in exchange, you collect the rest of those 90% emissions, right? And so you get all the upside and of course the downside too. But generally speaking, you're hoping for all the upside whilst also generating fees with very little downside risk, with very little impermanent loss risk. Now, to double click a little bit more on the concept of impermanent loss, right? Impermanent loss, essentially, if we can draw it out here, is let's just say you have Solana token and you have USDC token, okay? And you put $100 of both into an LP, a liquidity pool, right? Well, when you do this, you basically establish a bin range, okay? And this bin range is basically where your $100 of Solana and your $100 of USDC sit and accrue what is known as fees, right? And this is how an LP works. Now, let's just say the low end is $170 per Sol, and the high end is, this is a notional example, but let's just say 180. Now, as the price of Solana USDC fluctuates up and down within this range, every time, some trader comes, and let's just say this is our little trader right here, some fella, he's like, hey, I want to trade my Sol for USDC or vice versa, right? He's willing to pay a fee, like 0.01%. And that fee goes towards the people that are providing liquidity, people like you and me, right? That's where our APR or APY comes from. It's from all of these traders coming in, swapping Sol for USDC and paying that fee. And once our liquidity gets tapped, we get some small share of that pie, right? Now, what happens if Sol USDC starts to trade above out of our range or below out of our range, right? Now we are no longer in range. We are no longer collecting fees. And unfortunately, we also, due to the way that these LPs function, we basically incur an impermanent loss, right? So if the price of Solana comes down, we end up being overweight in our Solana basket. So we have 100% allocation to Solana tokens, but now 0% in our USDC bucket, right? Now, the inverse is true if the price of Solana goes up. If it goes beyond 180, we now essentially incur a permanent loss. We lose all of our Solana tokens, so we have 0% in Sol, and we then have 100% of our allocation in USDC. Okay? So what ends up happening, and the reason why this kind of sucks, is that if we lose all of our USDC, right, we end up having, thanks Tyler, appreciate the support on my doodles. We end up actually having a capital depreciation as Solana starts to go below $170, right? We're overweight in Sol, so the value of our Sol tokens goes down and down and down, right? Theoretically. Now, if you are incurring an impermanent loss to the upside, right, you might be thinking, oh, this is wonderful. I mean, I'm actually making money, right? Like my Sol gets sold off all the way to the upside. I end up having a little bit more starting capital. However, your upside gets capped after a certain point, right? If it goes to $182 per token, well, now you're 100% overweight in USDC. And if Solana keeps going up, well, all you have is USDC. So you don't actually get the benefit from all that upside. So long story short, right? You end up having a situation wherein you're trying to have this delicate balancing act between your 170 lower bin range and your 180. It can get to be a little bit overwhelming for most of us that don't want to manually manage, right? Or perhaps it's just too much of a time investment, or maybe it's not making sense from a fee generated standpoint, right? If for whatever reason your fees generated don't offset the cost of impermanent loss and your rebalancing fees, was it really worth it, right? Did you make any money? And of course, there's always different times to be allocated to various LPs. But at the end of the day, right, these vaults allow us to have our cake and eat it too, right? It allows us to essentially capitalize on what could be a lot of upside momentum very soon, whilst also generating fees. And you have various levels of safety wherein you can basically take, allocate capital to a like asset pair like Jito Sol Sol, M Sol Sol, right? And in doing so, you get, again, all that vertical price exposure plus 8%, 7%. And you can basically iterate on this across a wide variety of assets within the broader cryptoverse, from Ethereum to Sui to Aptos, etc. Right? And that's the beauty of DeFi. Welcome in the DeFi doctor with us.
Hey, my friend, Preston, impressing the audience already. I'm just listening in the background here to the amazing amount of value that you're giving to our audience already. So feel free. I would love to banter back and forth with you. So I won't steal the show just yet.
Absolutely. As you guys know, our resident DeFi expert, the DeFi doc, has decided to join us today. He is a wealth of information, and it's so awesome to have him here.
Thank you.
So thank you for joining us. But yeah, I guess to kind of wrap up, right, as far as how we should best position ourselves, in my opinion, one really great avenue of approach is to just make sure that you have as much capital efficiency as possible, right? If you're holding Sol, there are plenty of options where you can deploy capital, capture all the upside, and also generate fees. If you're holding Ethereum, same thing, right? One big, yield aggregator that everyone likes to use, especially here at Decentralized Masters, a fan favorite, is the beefy.finance application. Very similar to Kamino in the sense that you are able to connect your wallet and essentially generate yield, right, on Ethereum-based assets. And they're vaults. So oftentimes you don't actually have that burden of having to try and manage the LP manually. And there's such a wide variety of assets that you can look at, right? From all these different networks, from ETH main to Polygon to Base to OP, right? Really great opportunities where you can generate yield on top of the assets that you already plan to hold, right? And that's our goal, right? In efforts to be your own bank, right? To be able to generate sustainable passive income. Vaults are a great way to do so. And yeah, in my opinion, as we start to near, I'll go ahead and clear all my lovely drawings here, but as we start to near, the next leg up in this bull cycle, right? To me, you want to be in these LPs, you want to be in these vaults, right? Of course, there is various levels of risk. If you're in a volatile pair, it's a little bit more risky. If you're in a like asset pair, a little less risky, right? All the way up to, preserving as much risk, as possible. Being in stablecoin LPs, stablecoin vaults, where it essentially mimics holding cash, right? But on chain, and you can still generate yield, right? And yields generate anywhere between, like 7-8%, all the way up to like 20%, pretty sustainably, right? Just depends on the vehicle, depends on the opportunity, and it depends on what you want to do, of course, right? And in my opinion, it makes a lot of sense that as the bull market starts to kick in, you want to go slightly further on the risk curve, right? Just a little bit. I understand there's many of us that are conservative. We want to, prioritize capital preservation. But for those of you that want to capitalize on some of that upside volatility, right? You want to hold some blue chips. You want to hold some mid risk, some mid cap things, right? Across, hot sectors within crypto, be it AI based tokens, RWAs or real world assets, DPIN, and then maybe have, a small moon bag, if you will. Again, nothing that you're not willing to lose. Of course, investing is risky. Crypto is a very risky asset class, as you guys are probably aware of, but have maybe a meme coin or two, have some other small cap things that, if they take off, they usually do so in a very volatile, very violent fashion. And hopefully you can capitalize on all that upside. I'm curious, DeFi Doc, what are your, favorite vaults or LPs that you might be looking at right now as we start to head up into this next
What
leg
a
of the bull
great
market?
question. What a great question. Well, first of all, it's all based on long-term conviction plays, at least the majority of my portfolio. So I leave around 5, maximum 10% the further we go into the bull market cycle for the moonshot projects, as you mentioned. But the rest of them are basically spread across stablecoins. Always nice to have a little bit of collateral on the side just in case I need to purchase some assets at good prices. As well, Bitcoin and ETH is always part of it. And of course, the majority of my portfolio is composed of blue chips. And those blue chips are the ones that truly take the most work, effort, and research in order to find what I believe are those long term conviction plays. They're based on aligning with the narratives of this cycle. So you mentioned all the top ones: RWAs, real world assets, definitely DePIN, which is basically decentralized infrastructure or uh, physical equipment that is using the blockchain. Then we have, of course, AI. That's been huge over the last year and a half since ChatGPT, was released and people jumped
Took the
on the
world by storm.
bandwagon.
Yeah.
Everything is now using AI, and it's gaining momentum. I mean, we see massive, massive companies now becoming leaders in industries simply because they're integrating AI to be used. So based on those categories, I then pick and choose which assets I want to hold. And when I do choose them, let's say it's a list of 10. When I do choose them, I then divide the amount of money that is within each of those projects, uh, half by holding them simply in its pure form, and the other half by finding LPs. Something that you mentioned, which is very useful, are these aggregators that are popping up all over uh, the crypto space these days in various blockchains. And Beefy is a great example because not only does it have a huge array of blockchains that it aggregates these LPs from, but as well, it really makes managing those LPs very simple. Gone are the old days where you manually have to rebalance your LP tokens depending on the value of each of the assets that is within that LP, because normally an LP is composed of two different assets. There are certain aggregators that even allow more assets to be within that vault, but most of the time it is two assets. So as you see, this is why we have two names here, Luna and Wrapped ETH, for example, or Miggles and Wrapped ETH, et cetera, et cetera. Those are the two tokens that people have to have within their wallet in order to combine them to create an LP so other traders are able to use both of those assets. And basically that is the backbone of DeFi, enabling traders to use your liquidity that you hold within these tokens, this pair of tokens, and we are making the transaction fees. A little bit goes towards the actual DEX that facilitates the trade, and a little bit goes to the network, but then the majority of the profits actually goes towards the liquidity provider, which is us. That's the beauty behind DeFi. So the beauty that I love Beefy all about is the fact that you don't even have to hold each of those tokens separately because they have a zap function. So basically a zap function allows you to choose an asset that you would trade in order for you to execute and have that LP under management. You're allowed to pick and choose, for example, stablecoin to be traded automatically for two tokens that compose this LP in one transaction. So it's no longer you have to go to a DEX manually yourself and purchase Miggles and purchase Wrapped ETH and then bring them here and then combine them into an LP and have Beefy manage it for you. But you click once and basically under one transaction fee, all of those assets are under your management. So I love Beefy for that. A second thing that I love Beefy about is the fact that it automatically compounds your interest. So they do take a management fee. It's around, on average, depending on the assets, but let's say it's around 4.5% is the average. So if you are supposed to make 100%, it will give you around 95%, let's say. But because of this management fee, every time you earn interest in providing your liquidity into this pair, it takes the profit from that transaction and refunnels it back into your own position. So you automatically grow in the actual strength of that position, the strength of that pair that you're holding. The value goes up. And that's not even taken into account the appreciation of each of those tokens that also, well, hopefully if you made the right choices, goes up. So that it's kind of like a all-in-one package. Beefy is fantastic when it comes to that. And as you see there, my friends, in the top row, right underneath that black section that shows you basically your portfolio, you have an assortment of blockchains. Exactly. All of those colorful rings is a huge assortment of different blockchains that Beefy aggregates these LPs from, which is very, very convenient. Fantastic. Difference between compounding effect of APY versus base APR offsets the management fee and then some. Very
Exactly.
good comment
Love that.
from one of our great mentors at Decentralized Masters, Mr. Tyler Hubbard, who's a chart expert himself. Thank you for that comment. So yes, on that front, that's why I love Beefy.
Yeah, I'm right there with you. And to your point, the modularity of being able to engage with different blockchains, right? Oftentimes, you may end up with having, some Arbitrum, ETH on Arb. You may end up with, some stuff on Avalanche or AVAX, right? sometimes you just have like capital like in all these different, places, and being able to have kind of like a one-stop shop where you can say, hey, I've got like 100 AVAX just sitting in my wallet. What should I do with it, right? Like, what can
Yeah,
I possibly do? You can go filter, find these different, LPs. Maybe you want to take something more degen, something higher APY, of course. There's always, your classic, wrapped AVAX, USDC, volatile pairs. And then you've got, all the other ones, right? Like wrapped Bitcoin, AVAX, slightly more correlated assets. There's such a breadth, in stable coins, there's just such a breadth of various vaults and LPs, yield bearing vehicles that you can engage with, right? And that's the nice thing about these yield ags like Beefy, in my opinion, is that there is just so much optionality, and it really puts the power back in the hands of us, right? The people.
that's right.
DeFi empowers people to be able to do things that they need to do, move funds when they need to go, where they need to go, and yeah, and ultimately, you know, be your own bank, right? And that's kind of like the power of
Absolutely.
DeFi, in my opinion.
Well said, my friend. Yeah, so maybe we can as well show our friends here live on YouTube the fact other options of aggregators. And I think one of the most brilliant and well encompassed aggregator is actually on DeFi Llama. Now, DeFi Llama does not allow you to manage your assets as easy as it is here with Beefy, but most certainly it actually gives you more options. It aggregates all the LPs that are available. I believe recently when I was looking at it, it hit around 14,000. We can look at it right now. So Preston already pulled up DeFi Llama here. And then on the left side, we're going to go down to yields, which is the first exactly right there. And if we click on that, we have an assortment of, does it actually specify how many? Uh,
Tracking 11,170
11,000. There we go.
pools. Wow.
My goodness. So a huge assortment of options that are now available. And as we see, we can also filter once again through TVL, through APY, base APY, which is very different than reward APY. Base APY is rewarding you basically in the tokens that you have composed in the LP. So if we have Miggles and wrapped ETH and the base APY says 100%, that means 100% is going back to those two assets that you have composing the LP. Reward APYs, rather, could be additional rewards, maybe coming from the platform that the pair is found on, that the LP is on, or maybe the network itself will reward you additional fees, just simply to create that liquidity available to traders. Because obviously, more liquidity that is in a blockchain, it attracts more investors because there's a gain of confidence. There's more money within a certain network, so people are more um, willing to jump in and test out the waters there too. So this is a fantastic, I think, as well approach to filtering out very quickly different types of LPs, different categories that these LPs are in, uh, and of course reward structures, et cetera, et cetera. Obviously, as well, you can filter out based on the blockchain that these LPs are on. So, really good stuff. More manual. When you click on the actual LP, you jump into that LP's destination or where it's actually hosted. And then you can set up the LP directly on that protocol. When I say protocol, it's basically the website that exists on a specific blockchain, just in case uh, that language is a little bit foreign to you. But a wealth of statistics that Preston is now showcasing as well, and risk factors and supply APYs and 7-day moving averages, all good stuff. And there it is. You click that link website, and it will take you directly to where you can set up that LP. So here you would interact once again with this protocol. In the upper right-hand corner, you click connect your wallet, your Web3 wallet, to be using where the assets are that you would like to set up the LP from. And then here you can sort things out. Of course, we sometimes have to agree to certain terms of services, but that's okay. We're all used to that, I'm sure. And here is once again its own ability to set up LPs using this protocol's interface. So once again, that's a huge advantage when it comes to Beefy, where you have one common interface for any LPs that it has under its hood throughout the various blockchains that it aggregates those LPs from. While here, you can manually sort out and filter out more specific LPs that you maybe are looking for, maybe specifically depending on the assets that you already hold and you want to put them into action to work for you. So then you would have to kind of learn the interface of each of the protocol that those LPs potentially are on. And here we have some really interesting features that Preston is demoing for us, where you can actually leverage some of these positions as well. Preston, could you take us through this a little bit?
Yeah.
What do you see
So
here? How does this work?
So essentially, I do want to say for those of you guys that are kind of still new to this and just seeing, I know that oftentimes this can kind of look like sandpaper to the eyes or whatever, but bear with me. They tend to have a pretty more or less standard, I guess, UX UI or graphical user interface, if you will. The essentially the goal is usually the same, right? The goal is to find a way to deposit, two, sometimes more, but usually two assets of some kind into the LP, into the vault, the vehicle, what have you, and then establish what your ranges might be, your bin range. And I guess this one gets a little bit fancy in that you can actually leverage your position to some extent. Now, I'm not extremely familiar with how this actually functions. Maybe Tyler might have some good input here, as I haven't used this one before. But it is pretty interesting that you're starting to see like these innovations, like on top of what we can already do, right? But essentially, what you'd want to do is make sure you've got your two assets here, which in order to enter this LP, you would need your USDC, and then you would need your Velo token or your Velodrome token. You would specify how much you want to put in once your wallet's connected, of course. Now, I don't have any on OP here in this particular sample wallet, but if I had like $100, I'd put 100 here, and then whatever the equivalent is in Velo as well. And then once you have that, established, right, you can then deposit that into the LP or the vault. And then once you're in, you're there, right? And then you can start juicing those rewards. And then at that point, it really just comes down to managing the LP, or if it's a vault, perhaps just observing and enjoying the gains as they auto compound for you. And usually there is one more section that's going to show you like what your P&L might look like, your profit and loss, if you will, right? And also what your total APR, total APY, what your daily APR looks like, different, impacts to price, whether it's, slippage, different various volatility impacts, et cetera, fees, liquidation, et cetera, right? So this one's definitely on the slightly more advanced end, but definitely cool, as you can see that there are many options within the broader cryptoverse, the DeFi universe, to extract yield, and when in doubt,
Absolutely.
take, $50, $100, throw it in and try it out, right? It doesn't hurt to try. And that's how most of us built our chops in DeFi, was taking some money, throwing it in, and that's kind of like your tuition, if you will, right? And if something bad happens, well, at least you learned, right?
Well said. Well said. And Tyler here once again has added some very helpful insight, and that is most leveraged vaults require a borrow function of sorts. And that's exactly what you were showing there, my friend. The leverage, the 2x's, the 2.5, 3, and I believe 4x is the top mark. So you're basically setting up your LP and using it as collateral to borrow against it. So there's always a health ratio that you have to maintain. And that's the beauty behind DeFi. It's not like traditional banks where you go to a bank and they say, well, okay, let's assess, the value. that you hold for the bank. Well, you have, a job, you have a car, you have an apartment, and these are your liabilities, and you have a dog, et cetera, et cetera. And now we have an assessment, and basically we can lend you $100 or hopefully a little bit more than that. But we have to remember that traditional banks also used the approach of fractionalized banking, where each of those assessments basically has kind of like an insurance policy that is placed on that loan. So your loan is insured, but fractionalized banking kind of takes that entire concept and makes it a lot more risky because there are multiple people that are aligned to the same insurance policy. And in the States, it's actually up to 8 people. So if you're borrowing $1 million and then you have 7 others, well, everybody has difficulties within their life, different spending habits, et cetera, et cetera. And the bank, what it does is based on a threshold of approximately 30%. If 30% of people default on their payments, then it's a domino effect where all 8 people potentially could get hurt. And if you have a lot of people within a bank that have defaulted on their loans, that's what a bank run is. That's when the bank basically becomes bankrupt because they don't have enough money to accommodate for those losses. And DeFi has a much more responsible approach to exactly lending and borrowing. What DeFi does, it actually asks you to over collateralize all of your loans. I would like to take out $100. This is you talking to Mr. DeFi. I would like to take out $100. What does Mr. DeFi say? They say, stop. You have to show us collateral of $120. They always have that additional buffer zone of around 20%, which allows, number one, for values of currencies that you're holding as collateral to also fluctuate. This is why they have that buffer zone. But as well, it gives you a bit more of a comfort zone to know that you won't get liquidated if there's a small amount of differences in the value of the tokens that you have borrowed or used as collateral. So it's a safety measure. And I think it's a much more responsible approach to lending and borrowing, much more mathematical, that's for sure. And because of this, the world is basically looking at this as an evolution in the traditional financial system to apply such a thing, which is much more of a fair assessment than rather going to the bank and speaking to people that can base risk on whether they like you, whether you have a
True.
nice shirt,
Exactly.
So this is a very interesting protocol that you showed us here because it exactly showed us that. Are we still on? I kind of chopped up. I see myself frozen for a second.
There we go. But yeah, to Sam's point, to the DeFi doctor's point, right? You can essentially visit very many of these different kinds of lend borrow protocols, right? And it's very cool because instead of, again, to his point, having to go to a traditional bank, right? Like if you need a loan for whatever to help you buy a car, a house, what have you. Well, if you already have, say, $100,000 of, some crypto asset, right? You can essentially lend that amount, right, to a lend borrow protocol. They usually look very similar, right? So theoretically, like if I wanted to lend this, FUD token, I can essentially lend it here, right? Or, deposit it, earn some APR, right? It'll tell you like the deposit APR. So for this particular one, I'd be earning like 7% roughly, right? So you can max it out, you can deposit it, you basically sign your transaction. And just like that, right? Boom. You have now taken a crypto asset, a random crypto asset, right? This FUD token, right? Who knows what this thing is? And you've been able to supply it, right? And theoretically, I could just let this sit and accrue 7.8%, APR. And theoretically, if I wanted to, I could also borrow against it, right? And that's the power of DeFi. And this is exactly how DeFi gives you guys the tools to essentially be your own bank, right? Instead of having to go through the traditional system, you can, lend an asset, supply an asset, borrow against it, and any other token that you wanted, right? So let's just say we wanted to borrow against our, FUD token here. Again, maybe not like the best example, but theoretically, right? If you wanted to, after you've deposited the asset, you can, borrow against it. And generally speaking, these things will let you know what the LTV is here. So as you can see, for this particular protocol, the LTV for these specific tokens, so like for FUD, right? Maybe a bad example, it's 0%. But if we were to supply SWI, for instance, right? Same thing. Like let's just put, maybe like 50 SWI tokens into this protocol, right? We'll approve our transaction. Once it's in there, right? It'll let us know. We'll refresh and let it take our, new deposit. It'll actually tell you that you can actually borrow at a 70% loan to value, 70% LTV for this particular token, right? So we can actually, let's just say we want to borrow some stablecoin. You can actually go here. And as you can see, SWI lend, this protocol will actually let me borrow about 68 USDC, $68 worth of, USDC against my SWI deposit, right? My whatever SWI deposit that we have in here, right? So we have 50 SWI deposited, and then now I can borrow against that, here. I can max out. And then you can borrow, you'll sign the transaction, and then boom, you would get that USDC deposited right back into your SWI wallet, right? And this is the power of DeFi. This is the power of lend, borrow, and this is why a lot of us are here, right? And again, to kind of go back and bring it for full circle, right? In efforts to kind of capitalize on all of the upside for crypto, right? All of the upcoming, bull market activity, it's always important to make sure that you are as capital efficient as possible, right? And it doesn't always mean that you have to be, riding the next meme coin wave or, trying to capture that next trend. You don't have to basically take, or catch every single rabbit, right? I think the saying is like, he who chases two rabbits catches neither, right? In crypto, that can sometimes be true. So if you've got stable coins, maybe think about lending it, right? Or provision some of that liquidity into a stablecoin LP or a stablecoin vault, right? Juice that 15, 20% on top of, whatever you've already got going on. Likewise with Solana, right? Just like Sam said, with the DeFi doctor, you don't have to put every last drop of your Solana liquidity into Kamino, but maybe half that, right? Have a bag that you use for your DeFi stuff and have a bag that you use to just capture all the upside without worrying about managing an LP or a vault or what have you, right? But there is always opportunity across, all the different blockchains. So yeah, that about concludes it for me. I know we had a couple of other very interesting topics that maybe we can hit on real quick as we look to close it out here. I will go ahead and switch over to this tab real quick. I don't know how many of you guys are aware, but the Florida Chief Financial Officer, so Florida's CFO, which, by the way, I didn't know that states had their own CFOs, but he actually came on and was saying that, hey, we are advocating for a strategic Bitcoin reserve, right? And I think this is why, one of the reasons why people are factoring in a Trump presidency as being such a bullish thing for crypto, right? And we're starting to see this sentiment echo across all kinds of TradFi, traditional finance institutions, smart money, big business, right? MicroStrategy kind of did it, was one of the first movers to basically take and adopt Bitcoin, a Bitcoin standard, adopt Bitcoin as a treasury reserve asset. And many other pro crypto, pro Bitcoin people are starting to see the same thing, right? I mean, why wouldn't you want to capitalize on all this upside? I mean, if Bitcoin is truly pristine, financial power projection, I mean, this is the weekly chart for Bitcoin, right? Why wouldn't you want to capture all this as a potential hedge against currency debasement, which is rampant in the world today, right? A hedge against geopolitical instability, right? Civil unrest, what have you, whatever the narrative might be. People are starting to see the upside, the potential in Bitcoin. And we're starting to see this not just with Florida here, but Microsoft, we all know who Microsoft is, right? They have a very big proposal to vote on custodying Bitcoin on the balance sheet, very similar to MicroStrategy's playbook, right? Who owns a significant share in Microsoft? BlackRock. What did BlackRock pioneer? Bitcoin ETFs, right? Trump, same thing, wants to help institute Bitcoin as potentially a strategic reserve asset, or at least make it a national strategic imperative to proliferate Bitcoin, reserves across the U.S. Right, and again, that's why a lot of people think that at some point game theory kicks in, especially if Trump is elected, and that would obviously be a bullish thing for Bitcoin because everyone just starts buying Bitcoin. At least that seems to be the implication there. So, just thought this was interesting. The DeFi doc is back. Why don't you
Hey,
take it
my
away?
friend.
And maybe
I'm
close
sorry.
us out.
I think we spoke too honestly about loans and how to lend and borrow in DeFi, and the internet locked us out there.
Yeah,
But
didn't want
glad to
us to
be
share
back,
the
my friend. Some
information.
interesting commentary you brought there.
Hmm.
We try not to get political, but we are observers from the sidelines of how this will make an impact on the crypto space. And there's some really interesting things that are happening these days. From both sides, I would say. Both are now turning very bullish towards the possibility of, well, obviously, of regulating crypto assets, digital assets, looking at frameworks like the MiCA framework that Europe abides by, and other areas in the world of how they're regulating crypto assets, and trying to apply that as well in order to increase the adoption, the use cases, and as well, I would say the industry investment. It feels kind of like the states are kind of falling behind when it comes to the pace of how quickly blockchain technology is being used in every single industry these days. And this is why I feel it's on the top of their agenda to make sure that the innovation as well is kept within the states, and they have a little bit more of a share within this space.
Exactly. No, I 100% agree. And, historically, the US has kind of been falling behind as far as crypto regulation goes, crypto adoption. While it seems like our competitors on a geopolitical scale, BRICS nations like, Russia, China, they seem to be embracing crypto and adopting these Bitcoin standards, and really pushing forward to try and make crypto a very important part of their, country, GDP, et cetera, right? And I think that perhaps the U.S. can take some pointers, right? Perhaps we can learn a little bit from that and push forward for some good crypto regulatory oversight that makes sense for everyone involved. Push for ways to incorporate Bitcoin mining into the economy, and different ways that can be useful. Energy runoff, right? There's so many different things I can think of that we can do to make crypto and Bitcoin a productive aspect of society, a productive asset in general. So yeah. But guys, I know we're a little bit over. I think that about does it for us today. I just want to thank all of you guys for being here. Again, this is a big moment for us here at DM. This is our first official podcast. So again, thanks to all you guys being here for this pretty historic moment. Thank you, Sam, the DeFi doc, the legend, the man, the myth himself, for being here and helping
Thank you so much.
helping facilitate an awesome discussion.
Amazing discussion. Absolutely. Thank you as well, Preston, for leading the charge on this initiative. Now, for all of our listeners, just in case you're interested, we've put together a free training that walks you through everything you need to know about DeFi, specifically how you can get in early and set yourself up the right way. So, if you're serious about stepping away from the instability of the traditional financial system, just head to the description, click the link, and access your free training. That is it. That is all for us, my friends. Thank you so much for listening, and we bid you a fine farewell. Until next time. Until next time.
Until next
Thanks,
time.
Preston. Have a good one.
Thanks, guys.
Cheers,
Take it
buddy.
easy. Cheers.